But if we over tighten, then we have the ability with our tools, which are powerful. Again, the powerful tools. As we showed at the beginning of the pandemic episode, Thursday, November 3rd, 2022, Maneco 64, home of alternative economics and contrarian views. So yeah, the Federal Reserve is the whole story this morning and last night. We're going to look at that today. To me, one of the most interesting comments Jay Powell made during his press conference was that he wants to keep you believing in 2% inflation. He doesn't want 2% inflation. He said he wants to keep the public believing. I thought that was very propagandish, and we're going to look into that. Before I start, I'd like to say, if you enjoy my videos, my regular videos, of course, make sure you hit the like button. Make sure you subscribe to my channel if you haven't yet. And share as well with like-minded people. And I'd also like to thank all of you who've been with the channel for just a week or a month, a year, 2, 3 years, for all your support, all your comments below. I really appreciate it. I try to get to as many comments as possible, and I do read them. Sometimes I do reply to them, but it's difficult to keep up with it as the channel grows. And that's why I have a Sunday live stream every Sunday at 9 p.m. London time for just over an hour, where you can ask me questions and I'll try to answer as many as possible. So yeah, thank you again. So in an ideal world, if you've been following me, we wouldn't have central banks. We wouldn't have to listen to one man for our decisions in the markets, in the economy, in business. And I don't listen to Jay Powell in terms of what I do in the short term, because I'm not trading anymore. Of course, a lot of people were trading yesterday, so there's a lot of activity. But you need to keep, I guess, abreast of what these people are saying. Unfortunately, the central banks are still in control of the system. And I said ideally we'd have a system with no central banks, where the markets determine the supply and demand and the cost of credit. So just wanted to read you first what Zero Hedge said about yesterday. It was the worst final 90 minutes to a Fed day in history, as JP Morgan warns the squeeze has been squoze. And Tyler, one of the Tylers, says it will live in the annals of market infamy as the day the Fed rug pulled the market, when first a very dovish statement sparked a frenzied buying spree, only to be followed by a blistering hawkish assault on the bulls during Powell's press conference, leading to risk free fall and the worst 90 minutes to a Fed day in history, according to Bespoke. So yeah, the stock market, the Dow dropped 505 points. S&P dropped almost 100, 2.5%. NASDAQ dropped 3 1/3%. And yeah, gold and silver had rallied. Silver got back above 20 briefly. Gold got just around 1672. I think the stock markets were, the Dow was up a few hundred points. Yes, it all turned around. The bond market as well turned around. The yields had dropped. Now they've risen since yesterday. But I thought it was interesting to listen to his press conference, and it was 45 minutes long. And I'm going to put it up in the cards if you want to listen to it. But I've taken some notes. So we're going to go through this statement he made at 29 minutes 52. So you don't have to listen to everything. You can go there if you don't believe me. So this is what he said, and this is to do more with inflation. And again, the Fed, what they're trying to do is not fight inflation. They're trying to keep you in their hamster wheel, in the boiling pot, so that they can extract, and by they I mean Wall Street and the top 1%, the hedge funds, the speculators, the private equity. They can extract the wealth from you because they've got access to cheap credit still and you don't. But they want to keep you in the game. You got to play the credit game because, as we know, the state alone is responsible for inflation. Inflation without government, or indeed against government, is impossible. That was said by a very influential banker from the early 1900s, early to mid 1900s, Felix Summary. We know that inflation is really the creation of currency and credit out of thin air. It's what the Fed does. It's not the CPI or the PCE or energy prices that cause inflation. The rising prices that are reflected in the CPI, PCE, and energy prices are the consequence of too much credit and currency chasing too few goods. And that's the Fed's main purpose. Don't believe what Jay Powell says. But I caught him yesterday at 29 minutes 52, and I'll read it to you what he said. By the actions that we take, though we help keep lower long-term inflation's expectations as anchored and keep the public believing in 2% inflation, by the things that we do, even in times when energy is part of the story of why inflation is high. I thought that was like really telling. And it's one of the reasons why I think Jay Powell is no hawk. He's a dove disguised as a hawk right now. So he wants you to keep believing that inflation is really 2%. And if it's a little higher in terms of the CPI, which is, again, a misnomer, it's because of energy, not because of the fact that their balance sheet has gone up like tenfold since 2008. As you can see here, yes, they've started tapering, but look how humongous it still is. Look at M2. Yes, it's coming off a little bit and creating a lot of havoc, right? But it's still massively inflated the system. And he wants you to believe that the Fed's got your back. So I thought that was very propagandish. He doesn't want you to believe in the numbers. He wants you to believe in the Fed's actions and propaganda, I would say. So I thought that was really interesting. And yes, he did backtrack on the dovish statement. And then the press conference starts 30 minutes later. And there's a comment about cumulative rate hikes, and the market took that as being very dovish. And then when he came on the podium, he gave a summary of the economy. He said they see the economy slowing down. He said that the economy hasn't really grown year to date. So the markets took that as being dovish, coupled with the previous comment about cumulative rate hikes. The markets thought that they might wait a little bit, and they thought it was a pivot, but then he was quite hawkish. But my point is not to focus on the hawkish comments. I think what he said is that rates are gonna top at a higher place than what they said back in September at their other meeting. So I've got some other interesting comments that I took notes on. And these two comments are related, but he made these comments to different reporters. And again, you can either listen to the whole press conference or you can go to the time stamp that I took. So this is at 18 minutes and 9 seconds. This is what he said. If we were to over tighten, we could then use our tools strongly to support the economy. Why do I think this is important? Well, our tools, use it strongly. What are the Fed's tools? Well, it's to print money or create currency and reserves out of thin air, to cut rates to zero, of course, and to bail out Wall Street. He says here to support the economy, but the people they really want to support, as we've seen recently with the Fed sending billions and billions to the Swiss National Bank, which has been used to probably help Credit Suisse. We don't really know. This just goes to show you that if things turn around, they're going to move very quickly. And how quickly? Well, I think I got the message here from him again. And it's a little bit to do with this over tightening. And it was to another reporter. He answered at 34 minutes 41. So let's go through this. I took notes. Again, if we over tighten, and we don't want to, we want to get this exactly right. So he wants a perfect soft landing, right? Exactly right. There was actually another reporter who asked a question about the soft landing, and he said the window has narrowed. He agreed with her because she said, hasn't the window narrowed for a soft landing? And he said, yes, you're right. And he said the reason is because of rising prices. Well, he calls it inflation. So he's saying that he thinks they can get it exactly right. And in another question from another reporter, he said, you're right. Yeah, the window is closing for a soft landing. So keep that in mind. But if we over tighten, then we have the ability with our tools, which are powerful. Again, the powerful tools. As we showed at the beginning of the pandemic episode. So that's how powerful and strong the reaction to an accident is going to be. It's going to be as powerful as in March 2020. And I think they're going to use, again, this go direct BlackRock strategy where the QE flows into outside the banking system. And that's one of the reasons why we've seen M2 grow so massively in the last 2.5 years. And that's why we've seen prices rise, because unlike from 09 to like 2013, 14, when they did the initial QE, this is going to flow into the economy, into the consumer again. And why is he thinking about that? Well, why did he even say that? Well, because I don't think he's confident that they're going to engineer a soft landing, that they're going to tighten to just the right amount. And as you can see by these charts, the Fed's balance sheet, NM2, we've already had the worst market conditions in like 100 years, and it's barely budged down, the balance sheet or M2. So to think that everything's going to be fine if they continue doing this, maybe he will succeed. But I think my main take from this is that we need to keep our powder dry. And what I mean by that, well, we got to keep stacking, because this is far from over. And the fact that all he wants to do is really manage the public's perception of inflation. He doesn't want to really kill inflation, because inflation is what the Fed does. It's like trying to stop General Motors or Ford from producing cars. That's their business. The business of the Fed is to inflate and to extract wealth from you, the general public, for their cronies. at the venture capitals, or more like the private equities, the hedge funds, the major Wall Street banks, and governments as well, because governments give the central banks the power to operate as a monopoly. And it's interesting that he said he was going to meet a lot of central bankers this weekend. I wonder if that's at the BIS. Someone asked him questions about the dollar and the foreign markets. But anyway, that's what I took from it. I don't think it changes anything. And I think when something breaks, the Fed's going to come with their very, very powerful tool, and we know what that is already. Every time, as you can see here, since 2008, the interventions have gotten bigger and bigger, and that's normal. That's unfortunately what an addict does. The hits of the effect lower, they have to take more and more of the drug, and it's the same thing for this fiat currency system. So enough of that. We'll quickly look at the markets now, where they are. It's 20 past 8 a.m. London time. We've got gold, spot gold at $16.2750. Yes, it's down $8. High's been 41. The low has been 26.50. Silver is down 8 cents. So actually outperforming gold slightly. It's at 19.14. Low's been 09. High's been 47. The Dow futures is up 27. The NASDAQ 100 futures is unchanged. And the S&P is up a couple of points. So not much activity here, but I don't expect it to remain subdued. We've got non-farm payroll tomorrow, and I think we got CPI next week or so. So those are going to be important as well. The currencies, we got sterling down 0.2%. So yeah, the dollar weakened initially yesterday, and now the dollar is strengthening because of the hawkishness of the Fed. Yeah, sterling is at 113.20. The euro is down a third at 97.80, and the dollar is unchanged versus the yen at 147.95. The yen was very strong prior to the rug pull, as Zero Hedge said in their article. Dollar is up 0.5% above par versus the Swiss franc, just below 101. And the dollar is unchanged versus the yuan at 734. Dollar is up a couple of percent, around 62.50 versus the ruble. So dollar has gone up versus the ruble. Let's look at the other currencies here. Aussie dollar is down 0.5%, 63.17. Dollar's up 0.2 versus the Canadian, 137.38. The Kiwi dollar is down 0.5%, 57.88. WTI crude down 1.3%, 88.30. Brent is just below 95, down about 1%. High-grade copper is down 1.5% at 340. U.S. nat gas is down 2.8% at 615. Dutch nat gas futures, well, that's up 8%. That's the European nat gas at almost 140. So we were at 100 maybe last week, and we're up 40% now. So let's finish off with the bond markets. We'll start with the UK 10-year yield. That's up 10 basis points at 350. The 30-year is up 8 basis points at 365. And the 10-year yield is up 8 basis points overnight at 414. Still below the recent high a couple of weeks ago or so, which was around 433. So there you go. If you enjoyed this video, make sure you hit the like button. Please share far and wide. Think about subscribing to my channel if you haven't yet. And with that, I wish you all a great day. Take care. Bye.